Good afternoon, everyone, and good morning to those of you joining us on the West Coast today. Siegel Rogers Casey would like to welcome you to today's online presentation, Investment Synopsis, Third Quarter Capital Market Review. Now I would like to introduce our speakers. First, we have Hillary Wick, Vice President. We have Matthew Katz, Associate Director, and Frank Salamone, Associate Director. Now I'll turn the call over to Frank.
Hi, everyone. Okay, I'm going to be starting out talking about GDP growth. 2013 through Q3 has produced an average annualized quarterly GDP growth of 2.16%. This is actually close to the average annualized quarterly GDP growth of 2.28% for the current 17-quarter expansion starting after the second quarter of 2009. This is actually kind of close to the last expansion cycle, the 2002 through 2007, where it averaged about 2.87%. Just to note, the average time for an expansion from NBER from about 1945 to 2009 was about 19 and a half quarters, or 4.87 years. So right now, we could consider GDP growth kind of in an average range for an expansion, given the most recent couple of cycles. Moving on to CPI. CPI and core CPI have been pretty benign for the most recent time period. Since July of 2009, which was the start of this expansion, average year-over-year CPI has been about 1.88%, and it has been 1.62% for core CPI. Right now, there's not a lot of inflationary pressures out there, so we don't view this as something that could really negatively impact financial markets. In terms of monetary policy, we're going to concentrate on the U.S., the Eurozone, and Japan. In the U.S., it's been kind of interesting. The Fed has been continuing on with quantitative easing and has given some mixed signals in terms of when they might end tapering. Last month, at the end of which was the end of the third quarter, they really signaled that they might start ending quantitative easing, and then that led to some turmoil in the markets. So then they decided not to actually taper the quantitative easing, and that was directly tied to them saying that they weren't getting the employment numbers that they really wanted to. As of yesterday, they actually kind of about-faced and said instead of waiting for more evidence that they would taper, they actually said that they expect the economic data to be better, so they might go forth and actually taper. So we really have to watch that closely as to in terms of what they were going to do. In the Eurozone hasn't had much of a change. They're going to actually be holding the rates the same. They might have to do another long-term refinancing option. And in Japan is really going to hold course. They really did a huge and very aggressive stimulus not too long ago, and they're waiting to see how that's going to start playing out. Turning over to the labor market and unemployment, U.S. unemployment has been coming down. It's right now standing at about 7.2% in September. The one thing about that was, even though it's been coming down a bit, expectations have been that payroll growth should be a lot stronger. In fact, the reason that it wasn't as strong as it was the real reason why the Fed didn't taper last month. This could negatively impact some other areas. Mortgage lenders are expected to cut back a bit just because they're fearing that rising rates will actually hurt mortgage applications. So that's one area that could be hurt. The labor force participation rate is still staying at about 63.2%, so not a lot of new entrants into the jobs. People aren't really looking as much anymore, so that's kind of been staying the same.